welcome to this very special live edition of the Making Sense podcast. Smart, simple share market investing. Now, this has been, as I said, so highly requested. Really glad that we're able to get into this for you. You hear a lot, right, about how you should invest and how funds make it easy. And then you go to start. It can be absolutely overwhelming, the number of options that there are. So, what are the different types of investments available? How do you know what's in them? What should you be looking at to know if it is right for you and your goals? And are there fish hooks to be careful of? I mean, there are always some fish hooks, right? So we are going to get you to the next level up in your share market investing journey today. I have some of my absolute favorite experts here to help us with this. So I am really excited for this one. It's going to be good. Now, if you do want to keep leveling up your investing knowledge, I do also have a free share market investing newsletter. It's weekly. And you can find that on franciscook.co.nz/invest. And you can keep building up your knowledge each and every week. But before we get properly into this webinar today, I do just have to run through a quick disclaimer, right? This is not, cannot be individual financial advice. Everything that we talk about here is general information. From there, you will then need to adapt it to your own individual financial situation. And if you would like someone to give you individual financial advice, a financial advisor, always the best bet. Now, we're going to introduce our wonderful panel. Do not forget, I am both host and technical producer, so forgive me as I bring them out one by one and I get myself sorted out here. Right, so first up, we have Dean from Kernel. Now, if you have been looking into investing, you have probably come across Dean's site. Kernel is a brilliant digital platform, gives you access to investment funds, KiwiSaver options, and he has his finger on the pulse of what is happening in the market right now. Next up, we have, there we are, the wonderful Kristen Lundman. Now, Kristen I have been talking to for years. She is currently the co-founder of PowerSuit, which equips women leaders with a playbook to accelerate their careers. Before that, she was the co-founder and chief executive of Hatch, a shares investment platform. So wide experience there. Really love having you with us here today, Kristen. Last but never least, I will bring out Tom. Now, Tom Hartman, another person I have been talking to for yonks. Actually, I've been talking to all of you guys for yonks. This is going to make us all feel old, isn't it? I have been talking to Tom Hartman for ages. He's the personal finance lead at Sorted. He's been my go-to guy for all things money, absolute years now. Great excuse to talk some more. Now, we're going to dive in, have a good chat to our panel. But as we get going, don't forget to hit subscribe to Making Sense, YouTube, Apple, Spotify, because of course, if you get pulled away for whatever reason, that's fine. The day is busy. That means you can listen to the replay. Apple, Spotify, YouTube, it's going to be everywhere there. So come back at your own leisure. But until then, while you're here live, drop into the chat any questions that you have. Even as we go, if there's more you want to know on a certain point, do drop that in, and then we can spend more time on certain things if we know that that is important to you. So, team, I'm going to whip around all of you on this first one. The different investments here. I mean, what are some key questions you should be asking yourself before you look into particular investments? Dean, I'll start with you.
Well, critical is, do you actually understand what you're planning to put your money into, right? And it is that aged wisdom. I think Warren Buffett's been a big champion of this, which is, don't invest in something you don't understand. It's very easy in today's world to see something new that's been launched, a new innovative way of investing, or even with things like digital assets, right? We've seen it from NFTs and others. Like, if you don't understand it, just pause for a bit and actually take time to research, learn about it, and fully kind of get to grips with what you are doing with your money, how much risk you may be taking on, and at that point you can make an informed decision. It's very easy in today's world with everything being digital that in a couple of clicks your dollars can be invested into almost anything these days. And so almost slow down and do your research and understand what you're trying to invest into.
I love that. Classic, timeless advice there. What about you, Kristen? What do you think people should be asking themselves before they look at certain investments?
I'd probably start with what do you need the money for? And when do you want to spend the money? Ultimately, you're going to be spending money on all sorts of things from your house. You want to spend money in retirement so that you can maybe do some traveling. You may want to travel in the next year. You may want to spend money by quitting your job in a couple of years. You may want to spend money on your kids when they're at university. And so you need all these different times and events where you need money. And so I think it's the question of what is it for ultimately? And then when do you want to spend it? And that should start the thinking around where each of those kind of buckets, I suppose, where it goes.
Yeah, that is absolutely brilliant. Bring it back to life because that is what all of this is about anyway, right? Tom, what about you? What do you think people should ask themselves?
Yeah, I completely concur. I mean, there's such great points. I'm in Kristen's club there about because I really think it helps. Well, even if we could step back a second and just talk about what investing is, because a lot of people don't have the difference between saving and investing and understand the difference between those two things. And at the simplest way to put it is savings is setting aside money for the future, but investing is really going to buy something and going to buy assets that can really increase in value over time or spin off in income. So the key question, it really is a powerful thing to frame the question, what are you aiming to achieve by investing, and what that money is for? To Kristen's point, I mean, it wasn't too long ago I came across someone who was aiming to build an emergency fund, a substantial emergency fund, but using a platform in share investing in order to do that. And so there could be a mismatch between the type of investment and what you're aiming to achieve.
That's actually a really good point. That leads beautifully into something that I've had a lot of questions in my inbox about lately. So, Dean, let's jump into this one. You can invest in so much more than company shares. We tend to say investing and we think shares. But, people have also been asking me about things like cash funds, bonds, shares funds, index funds being an example. So, what is sort of some real world differences between those that could help people sort of assess where it fits for them?
If you think about like today where we are, you kind of have three core buckets that people talk about. So you've got your cash bucket, which is the very safe kind of, low interest rate sitting with a bank. Sometimes you maybe a term deposit. Then you have in the middle there fixed income bonds, and that fluctuates up and down, but tends to be a bit more stable. And that's where you're lending money either to a government or a company, basically. And then the other end of the spectrum, which we tend to focus on, is the shares, i.e. you're buying a stake in a company. And they all have different profiles and purpose. We tend to focus on the shares because a lot of people are thinking long term. They are thinking longer than 10 years. They're regularly investing. They're trying to build long term wealth. But these other buckets do have a role to play. We tend to forget the bonds bucket a lot. Just doesn't really come up in conversations. But it can play a key part in a role, particularly if somebody who's a little bit more risk averse or closer to spending that money and they want a bit of fixed income where hopefully they get a return, but also at times bonds can move in the opposite direction to shares. The thing I've noticed a bit more, which is kind of a maturity now forming in the New Zealand market, very common overseas, I've seen massive growth in this in the US, is what's called money market funds or cash funds. And in the US now that's grown to about $7 trillion. So there's kind of one step up from a cash savings account, and that's where maybe people want to go and put their money. It's the deposit for their house they're planning to buy in a couple of years. Now, a cash fund or a savings account, sorry, in New Zealand, a lot of banks pay pretty low interest rates. And so what a cash fund does is it can hold in that fund maybe some term deposits, maybe some short term like bonds that are about to mature. So you'll get a slightly higher yield than leaving in a bank account. But you also have the ability to still get in and out. So it's not like locking up in a term deposit where you're going to be restricted. So it's almost a nice middle ground. And I've noticed that a lot more Kiwis are starting to talk about this, particularly when it comes to somewhere to park their short-term savings, emergency fund, or home deposit. Now, beyond that, which I think is going to be the fascinating thing as we look forward, is the real rapid change that's occurring globally, where there's a lot of conversations going on about the things that exist outside of that universe. So thinking about private companies, private like commercial properties, and I think that some of your readers may be hearing about is called tokenization, where companies are looking at how can they take this private company or this big private commercial asset and break it up into little fractions that you can trade. And so making these kind of historically parts of the investment universe that's been restricted to more higher balance wholesale type investors available to everybody. So I think that's going to be another big trend that people will start to see more of, and we can talk more to in the future as it sort of becomes online.
Oh, it's fascinating seeing how these trends are taking hold, aren't they? Tom, I mean, what you mentioned before as well about that balance between the savings and the investments. I mean, it also comes down to a balance, as Dean's hinted there, between the safety and the growth, the different purposes for your money at different times. So when you are trying to balance safety and growth, what should you be looking at to decide what's a good balance for your particular goals?
Well, the key thing with most of the funds, the investment funds that we're using in order to grow, is that each of them has a certain investment mix and asset allocation that goes with them, and that mix that Dean was just touching on too, of how much, for example, is in cash, how much is in bonds, how much is in shares or commercial property, really drives your experience. So, how much you might grow, how much volatility, how much ups and downs in value you might end up experience. So the type of fund really becomes central there. Effectively, when you're finding your fund type, and we pretty much got 5 labels that we typically use here, and we've just been talking about defensive, but there's more conservative ones which hold mostly bonds, more balanced, which are between shares and bonds, then more growth funds where you start to get an allocation of shares that's much higher, or all the way to aggressive funds, which are primarily shares and commercial property. And each time you find your fund type, you are effectively finding out the level of risk that you're comfortable with. And that really needs to be, it depends where you're at on your investment journey, but it also highly depends, to Kristen's point, on how soon you need that money back, your time horizon, and how comfortable you are with those ups and downs. So then after that, in terms of safety, to your point, balancing growth and safety, that's when you want to think about diversification within that mix, that allocation that's within each of those funds, and really start to unpack, well, how diversified are you if you have a certain proportion of shares in your fund? Well, where are those invested, and how spread is the risk that you're taking on by investing in a given fund, for example?
Yeah.
Sort of obviously got some great tools for this, right? To be able to understand your risk profile, like how comfortable are you? So it is the go-to space for kind of just the guides and tools to work through this, and then to figure out where you want to sit on that sort of spectrum, like how much. And it's not necessarily one spot. Kristen touched on it, right? Where you may have a bucket that is in an aggressive fund, but you may have some that's more conservative. Again, like you're not just one profile. I think the thing I've noticed with some of the surveys though, and people respond to them and then say, oh, I'm a balance from a high growth. It's like, we all do these things in theory. It's when the real world hits, and we see it through like COVID, right? When your money actually falls, not just the theory of, oh, how comfortable will you react if it fell 20%. When it actually happens to you, we tend to be a bit different to maybe what we responded. And you see that small percentage of people who react and maybe change in that moment. So you've got to really make sure you question yourself and reflect of, am I really that comfortable with a 20 or 30% fall?
I love that
Yes.
thought of self-awareness. Like, you both raised self-awareness. And what's interesting is that you don't actually know how you're going to react to something when under pressure. And if you think about yourself, how you navigate your life and the workplace, and yourself as like navigating your career, like when you're under immense pressure, getting really aware of how you react under pressure is a good indication of how you're going to react when like everything goes to custard, which I love. Francis, can I talk about risk for a minute? Because I have like a
Do
bad.
it.
Okay. I'll talk about risk because when I was 26 years old, I walked into a financial advisor's office because someone was like, you should do that. And like, I was like, I want to be good with my money and I want to do this. And he asked me about my risk tolerance, which is why I get a little bit like, "Ugh," when I hear that word, because he was like, what will happen? How will you feel if you lose all your money? I'm like, not great. I won't feel great if I lose all my money. He's like, okay. So he classed me as low risk tolerance because who's going to answer that? Like, yeah, that's amazing. I want to lose all my money. And he put me in a balanced or conservative fund. And this is for my retirement. And I'll never forget that because it wasn't until 15, 20 years later when I was like, hang on a sec, like this is something that's going to be in the markets for however long. And that wasn't necessarily like the questioning of my risk tolerance and making decisions on that. And I probably have lost out on like $150,000 or more, like really annoying. So when I think about risk, I kind of think there's like danger, right? Like we've got danger in our life. Like if you think about, I don't know, burning your house down or getting hit by a car, like we are mitigating risk all the time. We're trying to avoid dangerous situations. The same as if you have someone on a plane next to you be like, I have a really hot tip and there's a new crypto coin, or, you know, that might be like a danger thing or too good to be true. So we kind of tend to avoid those things. But when it comes to investing and putting our money to work for ourselves, it's more in the class of like, have you ever moved to a new city, or have you ever had kids, or have you ever started a business? Like we take risk all the time, and all it means is that we're stepping into something that's slightly uncertain, but we step into that territory because the payoff, like the ultimate like thing of that going well, is worth it. And investing in something that's reputable and that we've researched is kind of the same thing in that it's uncertain. And so, yes, there is some risk involved, but that's when you can start to kind of think, just like you might with a big life change, like what's the best case scenario? What's the worst case scenario? And that's where you go to like, what happens if I were to lose everything? Or when do I need this money back? And that should help a little bit with investing. The same with taking life risk.
That sounds like a bad advisor, you know, because that's exactly the opposite.
That was my one and only, my one and only. With one. So
Because like the
I
whole
love
role
how
of
you
it-
say
terrible.
I lost $150,000 and it was very annoying. I'm like, that's yes, that's well
what you were
up on the
talking-
list of annoying things.
what you were talking about, Kristen, is exactly that. The role of an advisor is a professional that when you are uncertain is to help remind you, hey, you should be doing this. You may be uncomfortable, but I am here to guide you through that. Rather than, I'll make my life easy so I'm not having to balance anything and I'm just going to put you where you think you are and then take some money. So, yeah.
Yeah.
Also, there's now risk and later risk, right? So the now risk are things like, you know, your house burning down today, but the later risk is missing out on that $150,000
Yeah, I
and
think
being
that's
more
the
prepared
risk.
for the long term.
That's kind of, and I remember this at Hatch a lot of like, well, the risk of like, what happens if my money goes down tomorrow, which is, that is, you know, obviously in the share markets, they go up and down all the time. They are an uncertain environment. But ultimately, I think we have to get comfortable with that. And that's where we kind of have that self-awareness of where is my money best placed? Like how comfortable am I in the short term of it going up and down versus the long term up and down and over time. You know, we know that with certain investments, on average, they do tend to go up. But yeah, it's just interesting to think of it that way, and to do some bit of soul searching about how comfortable you are with uncertainty. And just like in life, the risk of doing nothing is often worse. And also, education always like helps. Like the more we get educated about driving a car is kind of scary and uncertain when you first start, but the more you get comfortable with the rules and how people react and how we navigate it, it is becomes second nature. And the same can be true for investing. Like it's scary when you first step in, but when you start to learn the basics and keep things simple, not as scary.
Francis, I always love the way that you talk about volatility not being a bug, it's a feature, right? I mean, you know, it's a thing. You're stepping into this environment where values go up and down in order to grow that much more, but it is uncertain.
Yeah, it feels horrible at the time, but it is actually a key part of how you make your money in the long term. You simply cannot avoid it. Look, this is something as well. I have had so many people ask me about this, so I'm going to run through this with all of you. I'm going to start with you, Dean, because I've had lots of people say, okay, you've convinced me. I want to start investing. But then they go to an app or they start researching options and they just get overwhelmed. I mean, I love that there are so many options for people now, but it can also go the other way and overwhelm people even within just one platform. So, Dean, do you have any advice for cutting through that noise, getting things down to a short list and figuring out what are good options for you?
Yeah, I think what we tend to talk about, and it's will be the same for everybody here. We know things like diversification are really important. The things that you can control, right? You want to keep your costs low. You want to be diversified, and there are lots of ways then to invest beyond that. So it can be buying direct shares. It can be picking and choosing your own mix of funds or index funds. But for most people, actually, you step back and go, almost the replication of what we're familiar with KiwiSaver. We're talking about those diversified funds, conservative, balanced, high growth. These are a combination. So you take a high growth fund, it can be a combination of index funds already pre-made for you. Yes, that's available in your KiwiSaver. You can also do that with your general investing. And that is actually probably a really great place to start. And probably for a lot of people, probably all they need for their long-term journey as well. You may then want to add a few things along the side. Chris and I used to talk about it a bit with sort of core satellite investing. But starting with those pre-made diversified funds, it takes a lot of that decision making out, because then really the only thing you're trying to determine is this money long-term, short-term, medium-term? And then you match it up to the right bucket and then get started. So that removes a lot of that noise and selection challenge, and enables you just to focus, get in the game, regularly invest, and then over time, when you build out that confidence, you can start to amend or add to what you're doing.
Yeah. And I've certainly had a lot of people say, look, I love the idea of a fund. I'm not entirely sure what's in them. So what can people look at to figure out, okay, there's all these different funds. There's like 20 saying, here's a global fund. And then they're saying, well, which one's better? What sort of criteria should they be running through on those, and where do you look for it?
Is that a question for me, is it? Or,
Yes.
well, actually, it's a great place for Tom, right? Tom's site has actually a universe of the funds that are available in New Zealand. And so, that's a great point that you can go in there and you can do that profiling to determine the diversified funds, or you can see through that list, hey, there's global. And, the bias here is obviously the fees are something you can control. Don't make a selection decision on historic performance. That's probably the other big one to avoid. And just trying to, again, filter down your universe. I think the great place to start is still those diversified, because that's kind of got everything in one for you before going to, I want a global fund, I want a New Zealand fund, I want a emerging markets. You can do all of that, but Tom, maybe you want to share the ability of sorted and how you can kind of filter through the universe.
Yeah, I think it's one of the things that we wanted to cover here anyway. We've got two comparison engines on Sorted. And this, I should say, there's a great team behind the scenes. This is not just me working on this stuff. So shout out to them. But essentially what we're doing is that all the fund managers in the country are required by law to disclose, including Dean, to disclose, what's going on with their funds, what funds they're offering, how much they cost, how they've performed in the past. And what we've done is we've taken that data in either in the KiwiSaver space, which is a tool called the KiwiSaver Fund Finder, or in the wider space, which includes non-KiwiSaver managed funds, which is in a platform called Smart Investor. You're really able to sort through specific funds of a given type and compare them to an average of that type. We're trying to help people compare apples with apples, not apples with pineapples, which can often happen in this space. And then we try to do that by using key criteria. So one of the first we've already talked about, which is risk level, which is really about the type of fund. So once for example, you're looking for a high growth, aggressive fund, you can, sort through funds of that type. And then you can look at them by how much they cost. Now, financial products, maybe we'll get into this a little bit later, are a little bit different in the sense that usually you pay more and you expect to get a better product. In financial products, you pay more, especially in funds, and less comes back to you sometimes, literally. So you have to make sure they're reasonable. In the KiwiSaver space, we help people compare by services that the provider offers, and that's the next key criteria there, whether how they communicate or how much help they give you with your investments. And then finally, we do include performance, how it's performed, and we try to go as far back a look as you can that's practical, which in our case is 5 years, looking at the annualized returns over 5 years. And so again, you're able to compare apples with apples, and then you can start to unpack what's really in these funds. And on Smart Investor, you can look at the entire portfolio holdings. So for example, the funds that are offered by Kernel, you can actually look in and see what they're made of, and how they're, for example, hugging an index, how much they're going to cost you. And the KiwiSaver Fund Finder, it will actually calculate for you up until retirement how much you might pay in fees if you're invested in a given fund. And so you'll see that a lot of what Kernel offers are some of the most low cost options on the market there. But don't just take our word for it. You could see the entire population, as Dean mentioned.
Can I
Yeah,
add something on mindset, Francis?
Yeah, do it.
You're like, they're taking over.
You are, but I love you all for it.
I just feel like I just saw a little comment on frozen in fear to even start, and I just want to borrow from like PowerSuit, our new business, and it's a PowerSuit principle, and it can be applied to investing as well. And quite often in our careers, we're professional development for busy people, and quite often in our careers we never feel ready. It's like, oh no, I've got to do this leadership course before I'm a leader. I've got to do this thing and learn how to do this before I do the thing. So we have a really strong fundamental value of you can learn by doing, and I think the same theory applies to investing. In fact, it was born out of Hatch. That's why we're doing that. And if you just switch your mindset to, you're not trying to find the best investment, just like with your career, you're not trying to find the best time and the perfect time, because it'll never happen, and we'll just talk ourselves out a bit. But what if you're trying to find a good investment that you can stick with, or a good decision that you can stick with? And that can come through research on Sorted, it can come through AI, like not to I think AI is a really wonderful research tool to kind of start that learning and education as well. Although there's lots of great stuff out there. Hatch does an investing course as well for beginners. But I think the thing is what is a good investment that you can start with and just get going and not have it be perfect? And I think best and good are very different goals. And best often paralyzes us, whereas good just releases the pressure. And you're like, I'm just going to start something today. Just wanted to share that.
And that's exactly the paralysis, right?
Yeah, and I think that's so important.
But to Tom's point, there's lots of criteria you can try and judge on, and everyone then freezes up. Do I pick based on that one single fact? It's like, no, it's like it's a great way to get a bucket or an area that you want to focus in on, and then you can go and kind of find the one that speaks to you. And that may be much more than fees or anything else. It's like, what am I feeling comfortable? What's speaking my language I can relate to? And I feel like these guys are in tune with me, and I'm going to get started on that journey.
And I feel like probably 80% good is good, right? Like 100% is never going to happen. We don't have this expectation anywhere else in our life. 80% good is good. You can always course adjust as you are going. Tom, what were you about to say?
I was just going to say that maybe best is reserved for fund type. And then for the individual funds that you pick, you're looking for a good option in that area. We can't tell the future. Not enough people say this. We don't know how it's going to turn out in a given fund going forward. We could see how performance has been in the past with no indication of what's going to happen next. And so you're really looking for something solid, where fees are reasonable, where the provider is reputable, it communicates well with you. And then that performance hasn't been subpar, compared to peers, because that can sort of be a sign of bad management, that all these funds have gone through similar economic conditions, and some haven't been managed very well as they go through. So if anything, that's what performance can tell us.
It's a great place to point that, don't also just trust the banks and think that they're safe because they're big, that they're going to give you a good outcome, and look around, because there are a lot of, from Hatch to Kernel and everyone else, there are a lot of actually other places coming in that are much more focused on the customer today than ever before. And again, people can just jump to, I know the bank is big, that means they're doing good for me. Not
You
always.
know what's even bigger is some of the fund managers internationally that you end up investing with.
Yeah.
And they're even much more established, some of those index players, without naming names. So banks are big, but there's even bigger players in this pool.
And we've given a shout out a few times to the sorted tools. So I'm just going to send people directly there if they are wanting to do some of these comparisons. Sorted.org.nz/tools. And you can do things there like the investor profiler. You can find the smart investor tool. You can find the fund finder for KiwiSaver. I have shouted that out so many times. I love the fund finder.
Thank you so
There's
much.
masses of tools on there. We love them. Your team does a great job there, Tom. Kristen, you must have seen so many, not only new investors, but I feel like people who start investing and they get going, but they still feel a little overwhelmed. And it can feel like a lot, sometimes even in the first year or two, as you're sort of finding your feet and figuring out how it all works. So you must have seen a lot of people come through in your time at Hatch. Is there something that people often get wrong at the beginning stages of their investing journey? And is there something they can do to counteract that or mitigate that?
Yeah, I wonder. I mean, we could never see into people's portfolios, so I just want to make that clear. But what you can get a sense of is what people are doing just based on popular activities that are happening broadly on the platform. And I think a couple things happen is we can overcomplicate things, like most things when we first start. And so I just wonder, there's a concept of diversified and what being diversified means. And people immediately think of diversified as I need to do lots of things. Like I've heard about the S&P 500, so I'm going to do that. And then I'm going to do, obviously KiwiSaver. Let's put that aside for now. But let's say you're opening up something a little bit shorter term and you want to have that money accessible at some stage in the coming years. So you might look to funds to do that, various ones. And then, I've heard about bonds and I've got to get that going. And I've got to do individual stocks and I've got to get that going. And so I think there's this perception that they, because they're invested in lots of bits and bobs, they are diversified. But what's something that is so interesting, what I'm finding lately is, one of the really popular global funds that a lot of people start with, S&P 500 funds, is like massively tech, right? Like, so you've got, I think 40% of that fund right now is like in tech, which is in like the top 9 tech companies in the world. And then what you'll find is people then go buy individual stocks in that tech because that's what they know. They know Apple and they know Google and Amazon. And everyone's investing in Nvidia, so I need to do that too. So then they've got them out again. The KiwiSavers will have those tech stocks in them again because they make up so much of the share market. And so all of a sudden your world is complicated because you've got bits and bobs everywhere, but you're really heavily concentrated in like really big tech stocks. And so your eggs are not going to move in different directions when bad things happen in the market. Like all your eggs are going to drop. And so I think diversification doesn't mean lots and lots of bits and bobs. It means keep it really simple. You may want to research a little bit about global fund, like just to get a wide, like that one global fund might be more diversified, for example, than having 6 things going on for kind of shorter term stuff. So it's just kind of raising a bit of a flag there that diversified might not actually be diversified. And also at the same time, don't overcomplicate it. Like just keep it super simple. Start super simple with a really diversified fund and then go from there. Find your feet, find your confidence, and then go from there.
Too right.
Yeah, absolutely. And we're getting some great questions. So, team, do keep dropping those questions into the chat. We are going to come to those. If you've got questions on your mind, drop them in. And don't forget, if you do have to step away, if you're going back to work soon, then just hit subscribe, whether it's the Making Sense YouTube, Making Sense on Apple or Spotify. This will all be put up there afterwards so you can listen back to it. You don't have to miss out on anything just because life happens. But keep dropping in those questions there as we go. I mean, I think one of the things that a lot of people think about, especially to your point, Kristen, about, people think, they get the point that they need to diversify. You shouldn't just invest in one thing. That can be a very risky strategy. So spread your money around different countries, different companies, different industries. And yes, often that can be done through just one fund rather than 20. You don't have to make it super complicated. how do you look at what is actually in a fund? Sort of what sort of metrics should you be looking at when you're doing things like you're hunting out that product disclosure statement, right?
I'll answer
So,
quickly and then hand it over to the experts. But I would be really curious, and you'd mentioned it before, Francis, about finding the top holdings. And because I've just, obviously, I think that's such an interesting phenomenon right now. Look at the top 10 holdings of the S&P 500. This would have been Warren Buffett's advice, right? Like just do that and live with it. But now we've got, when he gave that advice, is to sit in the 500 largest companies in the US and just sit and you'll be fine. I think the concentration of the top 10 funds were only like 20% or something. Top 10 companies made up 20%. Well, now we're making up 40%, and it is all tech, and it is all in the US. And so for me, I would just be really careful about what are the top 10 funds. You can use AI to do it. You can find the disclosures. You can call up the provider that you're on and just be like, I need a bit of help, reach out to customer service, and just like, what are the top 10 holders? Are they like, what percentage is tech? What percentage is US? Just get curious about that. Then look at your KiwiSaver and kind of get a sense of that. And just get a sense of like, again, if you've got a basket of eggs, like they should be quite different. And so just get curious about what's kind of sitting at the top of some of your things.
yeah, Dean, I'd love your thoughts on that too.
Yeah, Kristen's nailed it, and I think Nvidia's become the largest ever single stock concentration in the US. So we are at times now. Historically as well, like just for background, like when we previously got to some of those highs in the 60s and 70s, the other slight difference was when it was concentrated was those top 5 names were actually all in different sectors. Like today though, it's all the same sector and the same outcome, and so you're quite tied to quite a concentration bet on one thing, which will play out over the very long term, but there may be bumps along the way. So if you think about funds, maybe I'll talk just practically because Kernel is an example of what happens. So on each of our fund pages, so you can find, you go to Kernel and we want to look at the S&P 500 or the Global 100, we have a bunch of information. So you can actually see every single stock holding, what percentage they are. You can see returns, but if you go to the fact sheets that we have at the bottom, and most fund managers will have a fact sheet, that's kind of a snapshot, 1 page, 2 page of key information. And we publish in that the top holdings, top 10 holdings, and a percentage. So you can see straight off the bat in one click, how concentrated is it, how many stocks are in it, what the sector mix is, how much is in each country. We also have added in what I think is quite cool because there's these risk ratings, and what does that mean? We've got a little table that shows what's been the largest drawdown, like the largest fall and the biggest rise in a 12-month window over the sort of a rolling period. So people can get a sense of actually not just where does this sit on a risk rating, it's like what actually has this done historically, like what could I expect? And I think that's a great way for people to just get that whole picture. And we've tried to do that. We talked about people addressing when they mix and match a few funds. We actually built this function in our platform. So there's an insights function so that when people have bought a few funds, it will combine the portfolio and show them, okay, what is the combination of those funds in terms of individual stock weights and country weights. So you can see, am I getting quite exposed? Because Kristen highlighted it before, like few people buy that and they'll add a few stocks and all of a sudden you didn't realize, wow, I've now got a very large holding in Nvidia or something else. And that may be fine, but it's a risk that you want to be conscious of. So yeah, there's lots of information. Start with the fund fact sheets. It's a really easy place. Pretty much every fund, KiwiSaver will have one of those on their website.
Nice. I'm going to dive into some audience questions to make sure we get to them while we still have some time. And Tom, I'm going to start with you on this one because this is a great question. Someone has asked, what are some options or tactics to start from scratch? I'm retiring in 7 or 8 years. Do I even bother? What are your thoughts on that?
Yes, you absolutely bother because you can accomplish a lot in 7 years without knowing a lot about your situation. Generally, 7 years is a significant amount of time and to build wealth. And there's a lot more that you can accomplish by saving and investing than you realize. And I'd invite you to come on Sorted again. These are free tools, so you can actually do some estimates and projections going forward of where you might end up, and you will definitely find that it is worth looking into and worth getting invested over that time in order to grow and to outpace whatever inflation does, because that's also the other unknown here. We don't know where prices are going to go and the value of money, what it's going to do, but we do know that over time, that by investing we can grow towards the future. So yes, it
I
is
would
never too late
remind,
to get going.
yeah, and I would remind, when we think about retirement, it's like, you know, that could be 30 plus years actually for the average person today.
There's not
It's a
just one
long,
retirement. Yeah.
it's a really long time. And hey, maybe you don't have income to top into investments during that period, but the more work you can do in those 7 years to set up a pot of money that's going to help feed you and top up your lifestyle 10, 20, 30 years into your retirement, you know, get into it. It's never too late to start. But yeah, don't forget
That
that.
money stays invested too. I mean, we've recently
Yeah.
built our retirement navigator, which just shows when you're drawing down just a
Oh,
bit
cool.
at a time, and that money staying invested over time, that, you know, growth still follows you through retirement.
Yeah, that's
Yeah.
great.
I love that you guys jumped into that because just took the words out of my mouth. It is so important, I think. You know, you think 7 or 8 years until that retirement deadline. Yes, that's an important deadline, and we often plan towards that. But the other thing as well is, as you say, Dean, retirement can be 30 years, maybe more. Who knows how health tech is going to keep advancing? We all
Yeah.
want a nice long one. And that means you're going to want your money to keep growing through that time. I often think of it as now money and later money. And you might have the money you're planning to use in a year or 2 years, and that might be in cash or cash equivalents. But if you're thinking of money that you're not planning to use for 5 years or 10 years, then that is money that can be in your later money, your growth money, your investment money. That is absolutely something that I would be looking at. And so if you've got 7 or 8 years, then brilliant. That's 7 or 8 years to work hard while you're earning, but you probably can keep your money earning after that, I think. Kristen, there was one here that I just need to find it again. Oh, actually, no, I'm going to go back to you, Dean, for a moment because this question is directly to you. So this person says, Dean, as a Kernel customer, I would love a globally diversified fund. The closest Kernel has to this is the global ESG, which is, of course, ethical investing criteria. So, however, I worry ESG makes the fund higher cost and affects long-term returns. So, Dean, your thoughts on that?
Okay, I'll try and keep this brief without getting too technical. One big thing to note with that exact index we launched, it has some screens and some tilts, but there is also, so it's basically a developed index fund. It's a developed world's index fund, like a total world that many people will be familiar with. What's interesting though is the methodology behind, while it does some screening and tilts, it is designed in the math of the index to basically keep incredibly correlated, basically follow exactly along the lines of the vanilla non-ESG. So the ESG is an additional benefit, but if that's not important to you, you shouldn't actually expect a deviation from buying just a standard world. It will be within the noise. So yeah, I think for investors, it gives potentially the benefit of both worlds. It's like, you're not sacrificing here. It's not intended to deliver outperformance or underperformance. And it does that by basically, because it's so diversified, it's still got the same sector mix, the same country mix as the vanilla world. And that's actually what drives most of the performance, right? It's when you drop out big chunks, like energy is interesting, like not having as much exposure, but energy actually only makes up typically 3 or 4% of an index. Of a world index. And so it's more if you were materially changing your tech or other big sectors that you'd be conscious of it. So there is that. The other one that I think maybe we found actually a lot of growth in is we launched a developed world index excluding the US. And that's actually been really, really popular. And why we've seen it be popular is a lot of people have started with the S&P 500. And so they've bought the S&P 500 or they're buying direct stocks in the US. And then they've done exactly what Kristen talked about. And then they go, oh, maybe I need to be more diversified. I'm a bit concerned about how much I've got in the US. And so this is an easy way to now just not have to sell everything and change what you've done, but add in that diversification and just buy the rest of the world. So if you still want to buy your direct stocks in the US or you still want to just hold that S&P, you can get a bit more control there. And we've found that actually that's been a really interesting tool that people have liked, because it sort of enabled them to just add to what they're already doing and not have to redo everything and kind of throw it all out and go, oh, what have I done wrong? Yeah.
I love that. I've definitely got a few in the mix still from my early days of investing that I'm weirdly sentimental. I know I shouldn't be,
Yeah.
but I kind of don't want to sell
Funny how
my
that works.
original ones. So there we go, a rebalance.
Yeah.
Kristen, there was one here that I was sending your way. Oh yeah, here we go. This one from Daniel. Should we be thinking portfolio management based on things like risk appetite? And I know you had some strong thoughts before on risk. So what do you think of that question?
I think, first of all, the word portfolio management is going to put beginner investors and people who are just finding their feet off. So I would just be like, don't overcomplicate it. Just look for really simple investments like KiwiSaver, and you might start with a fund. And then as you find your feet, really portfolio, all it means is buckets. You've got different buckets for different things. So you might have a portfolio that you do not want to touch for decades, like a retirement portfolio. And that might include like property or something, different things. You might have a portfolio for medium-term goals, and then you might have a portfolio for kind of short-term needs. If your washing machine breaks, or you want to go on holiday in a couple of years. So think of portfolios as people build buckets based on different goals. And then the risk is how we want to mitigate the uncertainty and things going up and down. So obviously, if you need money in 0 to 3 years, which kind of coincides with another question, you may want to be looking at like stuff that's like cash and high interest savings, or deposit, like term deposits, for example. If you've got a little bit like a medium term goals, that portfolio, that bucket of money, you may want to look at some balanced or something slightly more conservative than having everything in the share markets, because if we do go through a downturn, sometimes it can be that way for a few years. So if you need money in 3 years, they kind of often say, 5+ is kind of starting to think maybe move portfolio more into the share markets. But again, it's if you can sleep at night with that. Like if you are checking stuff every night and you need that money back in 5 years, and it is totally stressing you out, you have to be self-aware of that as well. And maybe you are going to be slightly better in a more balanced fund with a bit of cash and a bit of stocks, that kind of thing. So yeah, match your self-awareness with those buckets of kind of time, and ideally just set and forget.
I think that's brilliant. You've touched on several questions there, so thank you for that, Kristen. No, you've done really well, because we're getting quite a few here, and I want to make sure everyone feels heard. So there's a few there. I mean, there is a little bit of your point there where someone else had dropped in the question, investing money for a time period that may be too risky for stocks, but too long for term deposits. And I think that's exactly touching on those points you've raised there, Kristen and Dean, earlier when we were talking about things like the cash funds and the bonds, that there are those intermediate options that can get ignored. Now, there was one that I wanted
Boring,
to send
right?
your
People don't
way.
want to talk about the boring.
Yeah.
I remember I once wrote an article about how bonds were the granny that was about to get sexy. And they put these fishnet legs on my investing article, and I was like, right, I wasn't expecting that stock picture. The things that happen when you're in a newsroom and you don't control the headline or the picture. Now, Tom, yeah, I was going to send this one your way. What's the best way to maximize your investment? Should you be thinking about contributing smaller amounts on a regular weekly basis, or should you wait until you're ready to invest a lump sum instead? Tom, do you have thoughts on that one?
I'm so glad this came up, because we really wanted that. I was really hoping that dollar cost averaging would come into the conversation, which is just really the steady contributions over time. And it's actually a genius system, whether it's in KiwiSaver or into another fund, because if you think about it, what you're doing is you're buying assets, and you're buying more when they're cheaper, when values are down, and you're buying less when they're more expensive. which is when values are up and maybe valuations are in more towards the nosebleed territory. And this is a great system on the way up, because basically you're just contributing regularly a little bit at a time, and you don't need to think about whether you're getting into the market at the right time, the wrong time. One of the biggest mistakes that we see people make is trying to time the markets. It's time in the markets, not trying to find the right time to dump a lump sum in. So I'd encourage people to get in steadily. Little and long does the trick, especially when you've got goals that are in the long term. Obviously we think a lot about retirement, unsorted, but even things like, I don't know, investing for your kids' education, it might be, more than a dozen years away. And, this can be a really good way to think about it a little bit at a time.
Yeah. And I also think it takes away that analysis paralysis, right, as well. If you've got this big lump sum, you sit there and wait for the perfect time, and it's like, is it the perfect amount to put in yet? Is this big enough yet? Whereas you just invest as you go and you get going. I feel like just getting going is actually often the biggest hurdle, right?
Yeah, definitely.
It's not, and I think the other thing that, like, first time investors, it's like the emotions and behaviors you react to is actually the same. Like, we see people with the same fears, the same paralysis, the same concerns, whether they've got $10 million to invest or $10. Like, the behaviors are actually surprisingly the same. It's the same, just core raw emotions that we all go through, that mindset thing. And the regular drip feeding in is a great way to try and remove those emotions, but don't feel like it's something that you're doing wrong or that it's just an inexperienced thing. These are emotions, and they're experienced at all ages and stages.
Okay, well, we're running up on time here, unfortunately, because I think we've been talking about some great stuff here. I could go for hours, but probably everyone else has work to do. So if there was, bearing in mind that we all have very busy lives, we often only take in a little bit at a time. If there was one thing that people took from this conversation, and that was the only thing that they remembered from this conversation, what do you hope that would be? And I'm going to start with you, Tom.
Yeah, I think we've been talking a lot about growth, and fundamentally that's what investing is meant to do. It's really meant to supercharge, instead of just setting aside money for the future, hiding it under a mattress, or putting it in a low interest bank account. That we're really talking about ratcheting that up, of supercharging that, and therefore what we're really this is why investing is really part of most of our futures, is because we really, over time, people's needs tend to go up, and in order to meet those needs, investing is definitely going to be part of that solution. So if there's one thing, I'd say really the emphasis on growing through investing, and also it will help with our resilience in the future, of having money at the ready in case we urgently need it. Investing is a tool, a vehicle, a way of doing that, and that's probably the one key takeaway here.
Yeah, Kristen, what about you?
Yeah, I think they say the best time to start investing is yesterday, and the second best time's today. So don't overthink it. Just do something. At PowerSuit, we have to often say confidence is earned, and what that means is confidence comes after the action. So if you're going to go for dinner with friends, and you are going to spend $30, what if you took that $30 and did something? If you tested out how to buy a fund or how to invest that money and just found your feet, which then leads to a little bit more confidence. Just start to talk to your friends about it, or start to do a little bit more research. But don't overthink it. Take one small step today. And then the last little insight is, there are a lot of big, scary headlines going on at the moment, and we're bound for some bumps in 2026, but not to panic. Like, the point again is, if you're in a good investment, ideally just switch off and just get on with life, because you probably have more interesting things to do than to become full-time investors. So just keep things simple. Try to ignore the headlines if you're really comfortable, and sleeping well at night with your money tucked away. Yeah, that's what I would say.
Yeah, that's brilliant. Thanks, Kristen. All right, Dean, leave us on a high note.
Yeah, well, just wrapping up both of that, right? As we sort of touched on, emotions, our own emotions are the biggest inhibitors to our success. And so, getting started and then realizing that they are the things to control. And so the best way to do that, I think, is an automatic investment plan. Like once you've made that decision, you get started and just create that habit. Don't look at it. You can now set up, I'm going to put $10 a week, $100 a week, whatever that number is, and you remove the emotions. It helps you control the things that could inhibit your future success and removes that reactionary mindset. And so, I think you combine all that together, anybody can be on a really strong pathway to a really strong financial outcome, successful retirement, and have the choices they want to do the things in life that they are after.
I absolutely love that. And you guys have given us so much good info today, so much good food for thought as well. Thank you for ripping through all of that and for answering the questions. Our panelists, Dean Anderson from Kernel, Kristen Lundman from Powersuit, Tom Hartman from Sorted. Thank you guys so much for giving up your lunch break and your work time to chat through this with us. And thank you, of course, everyone who tuned in, who gave us your great questions. Before you go, do hit subscribe on the Making Sense podcast. You can sign up to the market memo to keep building your share market investing knowledge. That is franciscook.co.nz/invest. And until next time, have a great rest of your day.